Welcome to another episode of Leaders in Lending. I'm your host, Matt Snow. This week joined by Nat Hoopes, Upstart's very own head of public policy and regulatory affairs. Nat, welcome.
Thanks, Matt. It's good to be back on the pod.
Yeah, return guest, but first time I get the pleasure of chatting with you in this format, so I've been looking forward to this.
Yeah, it's going to be, it's a good month, I guess. We're almost in November, big election in Washington and around the country. So good time to talk politics and policy.
Yeah, and I was wondering, Nat, like this close to an election, a few weeks away, do you see increased activity? Are people distracted, or what's it like in Washington right now? What are people thinking about?
Yeah, ironically, it's kind of a time when Washington slows down and all of the operatives and all of the energy is in Pennsylvania or or Arizona or Georgia or North Carolina. And so it's definitely a time when a lot of people are anxiously looking at the polls. They're looking at the weather forecast for election day. They're really trying to kind of get a sense of who's going to come out. And I think the campaigns tend to focus on their core, turning out their core voters. And it's really a time when policy takes a back seat. So where I spend the vast majority of my time, which is regulatory work and the evolving policy landscape for Upstart and the financial technology industry really isn't the focus during an election season.
Yeah, a lot of variables that go into the outcomes of an election. Maybe there's an AI model out there being worked on to get more precise on what's really going to happen.
I can guarantee that AI is involved in the election, hopefully not in ways that we don't want. So we'll see.
Yeah, exactly. Well, hey, you mentioned you were in Phoenix recently, meeting with a bunch of examiners from the NCUA. What was that like? What's it like when a bunch of examiners get together and invite someone from a fintech in there to speak with them?
Sure. Well, we've just seen such tremendous growth with credit unions, right? So of our, 100 plus institutions, more than half are credit unions. It's a segment that has historically done a lot of what they would call signature loans, but unsecured personal loans are core product in Upstart's product suite. And so that means we have a lot of experience of working with credit unions, but we're also growing very quickly. And so the regional examiners, the examiners that are on the ground, they may be going through the first cycle where they're working with a credit union who signed up with Upstart. And so there can just be a lot of questions about AI, about unsecured personal lending, about the current macro environment, you name it. And so it was really good to just get in front of the audience where they could all ask any question they wanted, try to demystify some of the partnership, try to give them an understanding of how what we do is both similar to what has been done before. If you think about credit scoring and all the machine learning that's always gone into an AI that's gone into the development of traditional credit scores, and then kind of taking it to the next level in developing this full turnkey solution so that credit unions can really find customers, help them price customers, help them add that extra layer of a tool to be more accurate in how they do what they do, and then also servicing the customers. And so I think just giving the examiner audience from our perspective what a partnership looks like, how the partnership is overseen by credit unions, that was just a really good opportunity. The session went, I think, I want to say it probably went a half an hour over, just with the numbers of really good back and forth and dialogue that we had.
Yeah, that's great that there was so much engagement. Do you think they even understand or grasp like the need for outside partnership with fintech companies like Upstart? Like, do they understand the premise of why maybe some of these smaller institutions can't even do this themselves?
I do think that there's an education that needs to be done about the long-term viability of their customer base wanting anything other than a deposit account. I mean, we know deposits are pretty sticky. If you have been with a credit union for a long time, you may not be planning to leave on a deposit basis. But just doing the education that people are really searching for credit, not with their primary institution, but they're out there at the comparison sites. They're trying to get the best possible rate, just the way we would buy, an airline ticket or anything else. Like, we're going to be out there trying to find the best option. And that means, finding the internet. And so in doing that, really explaining to them the whole order of operations of how somebody comes to upstart.com, how they get matched with the credit union in their region, why, if the customer isn't walking in with a bunch of paperwork under their arm physically, it doesn't mean that the credit union can't have a viable lending program, but they're really going to need a partner. So we did spend a lot of time on that. I think the examiners, they can be suspicious. They can be skeptical. I think it's their job to be skeptical. There have been a lot of snake oil salesmen through the years saying this is going to be transformative, this is going to be the greatest thing, and then it doesn't always turn out. And so you have to kind of be willing to meet that skepticism head on, and then show why we're the kind of company, as a public company, that's really built to last, and is going to be here for credit unions for a really long time.
Yeah, the one thing that's helped me put some of that into context, Nat, is remembering that not only are they a regulator, they're the insurer, right? So they have a bit of a right and a reason to be skeptical. It's part of their job, right, to make sure that these credit unions are operating safely and soundly to protect their customers' deposits. So they're not.
That's absolutely right. They're an insurer, and there's a certain amount of truth to the possibility that even if something is only a reputational harm to the bank or the credit union, like that could then trigger sort of more problems, right? So they tend to be very interested in understanding at the front end of a partnership, when something is launching, because they know they may not be back for another 18 months or 2 years. And so, they want to make sure that it's, as they like to say, if something's right at the beginning, it can be right in the middle, and then it can be right at the end. So I think we did a pretty good job of walking them through the full life cycle and showing them how the credit union is really in charge of the size, the cadence of the partnership, the diligence process, the ongoing monitoring, the performance monitoring, the fair lending monitoring. And I think that really got them certainly more comfortable than they were walking in. I think that there were concerns, not with Upstart, but just in general with financial technology companies, maybe sort of trying to jump in and take advantage of small credit unions. And by the end, I think that they saw that Upstart's on that list of companies that's going to be around for credit unions for a long time.
Yeah, you made a good point about them, in their field exams being every 12 to 18 months. And the rate of pace of change in technology now seems to be exponentially growing, whether that's the availability of cloud computing, the different, algorithms and techniques you can use at that space, the number of third parties that are coming into play. So I would imagine they would want to be keeping up to date and learning as much as they could in between those exams and staying in sync with those things. Did you find there were any specific areas they were really, seeking more information on, or you found gaps in that they were trying to rectify?
No, I think they were interested in when in the process they can get a better understanding of the Upstart model. We talked a lot about what's appropriate to ask a credit union executive who may not be an AI machine learning expert with a computer science degree versus where it's fair for Upstart to answer a straightforward question that might be posed in writing. And so we sort of talked a little bit about that and how to have the exam process feel fair to somebody who isn't steeped in it the way our team is. And then we also spent a lot of time on open banking, interestingly, because I think there's a lot of skepticism initially in this idea of like, well, why would Congress in the Dodd-Frank Act, which I worked on back in 2010, why would we want to empower and say that the customer owns their own data? And then you walk through just the importance of being able to shop around for the best possible product and relating it to our own lives of how we do that all the time, and that applies in banking as well. And then making it come full circle and say, well, but now credit unions can actually take advantage of that too with partnerships like Upstart. Like, it's the credit union Upstart partnership that's enabling somebody to refinance their credit card that might be with one of the biggest banks in the country. And then all of a sudden that's now become a credit union customer that could become a member, right? That's going to be, potentially like, a depositor with that credit union or get other services from that credit union. We talked a little bit about that cross-selling. And so I brought up an example where, a credit union that worked with Upstart was able to cross-sell, something like 10% of their customers into other products and so forth, or their new members through the Upstart partnership into other products. And so I think it just positioning everything as on the long-term side of the health of the credit union, which is ultimately what they care about, right? They are, just like you say, they are the insurer. They want these institutions to survive, thrive. They're not so much interested in whether they grow quickly, but they at least don't want them to wither and fail. And so I think that was probably a really healthy kind of, I think, a little bit of an aha moment of like, open banking is meaning that our credit unions have a chance to compete for customers that they probably never had a shot at before.
Yeah, that's interesting. I wasn't expecting you to bring up open banking. Maybe spoiler alert, there's a mutual friend of ours who's been on the podcast before as well. We've been having some conversations about this offline and are planning maybe a future conversation. So I might have to get some more talking points from you, some more insight in your perspective on that. Because I think that the interesting correlation you mentioned, like, it's probably going to open up the opportunity for more partnership opportunities for credit unions, I would imagine, in a world where data is more portable or customers have more choice.
Yeah, I think so, 100%. And I think that the challenge for the smaller institutions, which we've seen across a lot of products, small dollar product being, most recently, there's, some studies of how many of the very large 5 or 6 banks in the country have built pretty viable, small dollar products for loans under $1,000, but it's a difficult product, difficult customer to underwrite on, in online interface. People want their money quickly. How are you going to compete in an area like that if you don't have a partnership? And so I think that there's a host of ways in which these credit unions can use the right type of partners to get them, the type of members that they want to find in their regions and offer them a viable, it's not just the product, Matt, as you know, it's like the user experience is everything. I mean, if it's going to take days and days to get through the process, they're going to just drop out of the application and go find somebody else who can get it done for them in an efficient manner.
Yeah, absolutely. I think we don't talk about that enough. Obviously a lot of attention, rightfully so, goes to the underwriting, the verification, all the data and insights that drive that. But, the user experience has to be seamless and continually evolving as well. So definitely a huge benefit to partnerships there.
Yeah, and we talked a lot with the examiners, at NCUA about the fair lending testing as well. How to keep a rigorous set of tests on the Upstart, models, doing some education on the Upstart is just one piece of the decision. So the person's, credit criteria as determined by other companies that are not Upstart, FICO being a great example, their credit score, things like their debt to income ratio, things that tend to create like who is actually going to be even eligible, can drive a lot of who gets declined, approved, et cetera. And then Upstart is sort of this piece that comes in afterwards. And so once they understood that there's a very big difference between using AI and all the alternative data as this really helpful additional layer, as opposed to, oh no, you're just turning over your entire underwriting to some black box that's not you, like that's a different story. And so I think people also the examiners don't always appreciate that when they come into the first time to examine a credit union that's signed up with a financial technology provider. They think, like now this is out of their control, and like showing, no, this is within their control. And not only that, but it's really these other tools that are what is driving the vast majority of who gets credit and who doesn't. And then the Upstart that's helping them really get a more refined look at those who would qualify within their desired region or other eligibility requirements.
Yeah, great point. Did you find, other than fairness, were there other things they really leaned into and kind of that compare contrast, like you mentioned? There's a lot of things that happen in the process that are the same as they've always been, with just maybe newer techniques, faster, more data points. Like as they went through that exercise of trying to think about, how is this similar or dissimilar from what they're used to? Were there other things that they tended to investigate harder?
I think that they had some prior assumptions that where we had a really robust discussion. I mean, there was one comment in one of the earlier forums, not the main forum, where, why would you need, the question was posed by an examiner, why would you need a lot of data points for a $750 loan? Right. And so I had to say, like, no, that's exactly where you probably need the most data points. Do you know what I mean? In a certain sense, that, like, it seems like a low stakes, but if you're trying to scale a program and you're going to have a whole lot of them, people who are, at a point in their life where they need to borrow $500 or $750 or $1,000 from a financial services provider, they can't come up with that kind of money on their own. You really want to understand, details about their, for instance, like, it might be their cash flow underwriting. Speaking of open banking again, through Plaid, or, details about their paycheck history, to really understand that they're going to be able to repay that loan, because it's not as though you're lending into some cushion where, there's enormous wealth there, and you're sort of saying, well, we know that this person is, both wealthy and has this huge high income. Like, many times these smaller dollar loans, like, you need more data. And so there, again, we had a lot of these, I think, really interesting prior assumptions that had to kind of be, like, addressed in a really direct way. And that doesn't mean it was uncomfortable. It's just it's a really important sort of evolution and conversation that we're having.
Yeah, and I wonder, Nat, like, how do the regulators, examiners think about that trade-off of, data versus human interaction, the cost, the ability to probe those decisions, one by one or at scale, the cost of those. Like, did you guys get into those? Whether it's, in terms of making the underwriting decision, reviewing fairness, like, just the difference, like you were saying, especially with a small dollar loan, every time you have to involve a human in any of that really makes that kind of a loan or a decision much more expensive. So you're not as able to extend credit to as many customers as you might like.
Yeah, we talked a lot about that. We talked about the value in automation, and again, in the value also in scale, from a, even from a performance standpoint, the importance of diversification. And I think that, again, in some ways, we're fortunate with the NCUA and credit unions because they have offered this product area a long time. As you know, there's, like, the PAL loan program in credit unions for small dollar loans. They've long offered, signature loans. And so, as opposed to some in the banking arena that mostly do commercial lending and might just be for the first time dipping their toe into consumer, closed-end installment like loans, that this is an area that is sort of bread and butter for a long time for credit unions, I think. And so that gives, there is a little bit more expertise. I think one of the things that was probably compelling to hear were just the anecdotal examples where I could say that those that have kept a traditional program running alongside Upstart have reported uniformly that the AI version has outperformed, right? Or that products where they've made this conversion to AI, or if they went with a prior vendor that wasn't using as much data or AI in a similar product, like that the AI version may not have been perfect, credit performance may not be perfect, do the macro or whatever, but that it outperformed what they had been doing, or what they were doing side by side with a different program. And so I think that was, I think, helpful for people to understand that, there's a context to what they have to view if they go into a credit union. They need to understand, like, hey, why don't I take a look at whether or not, a traditional portfolio is scalable? Is it actually going to become anything 5 years from now that can produce, some sort of healthy, income, for the credit union? Or so that's one question, and then also, is it actually performing in a decent way from a credit performance standpoint?
Yeah, that's a good point. That's one thing that typically helps skepticism, I think, is data and experience. So we're starting to get more and more proof points out there, and good point about, and the side-by-side comparison as well. So hopefully that helps.
Yeah, there's data on that. As you know, Matt, we talked about the data from DVO1 a little bit. So we were able to kind of share some data on Upstart's performance. And, while acknowledging that every credit union based on their region may have, variations, or based on their hard credit criteria that doesn't have to do with Upstart. Like, they could have different outcomes and experiences. But the bottom line, if you look in the aggregate at the performance, and the risk adjusted returns and so forth of the Upstart portfolio, it's been quite strong through the cycle. And so we spent a little bit of time on the macro cycle and sort of the importance of allowing credit unions the opportunity to see programs perform on all sides of the cycle, right? And the way that we encourage, institutions, obviously we want them to do as much as they can with us, but we're not pressuring them to do so. This is their program. They can decide to scale it up and scale it down at whatever times. We have our own macro tools. We talked a little bit about UMI and so forth. And so how does the macro index help inform the way people can be thinking about their risk appetite at any given time? But just as we invest in the stock market, you dollar cost average, it's not always good to be stopping and starting. In general, it's better to see things through the cycle. And so we talked a little bit about that and how ultimately being as inclusive as possible and seeing through the cycle is how we think people will probably do the best.
Yeah, I totally agree. That's typically when people need it the most, right? These access to these types of credit products as well.
Yep, 100%.
With the credit unions, a lot of them being kind of regionally focused or bound within certain states or field of membership, did you guys discuss, or what's your point of view on some of the state regulation that's happening out there? Or do you see how do things modulate between states versus a national, federal level, and thinking about lending from that lens?
Yeah, I mean, and this is an interesting dynamic because we know in DC there's this big, long-term battle between banks and credit unions, and most recently, you probably saw the CEO of the American Bankers Association, Rob Nichols, wrote to the head of the NCUA, Todd Harper, and about acquisitions and the transparency because there's now so many credit unions buying small community banks, and that's just the latest iteration of this. There's a fight when I was on the Hill about business lending, how much business, what percentage of the balance sheet credit unions could use for commercial lending, which kind of impedes in their turf. And then, of course, the tax status of credit unions. And so there is this long-term battle that's always gone on, and questions about the overall role of credit unions in their communities and for specific communities as opposed to broadly. Broader, serving broader constituencies. We have a lot of national credit unions. I just made the point of diversification that credit unions in general will do better if they're able to draw, members from as broad an area as they possibly can, and then they'll do better if they can, have, non-concentrated portfolios. Again, broadly speaking, as much as they can. So those that are in certain states and operating within those state guidelines and are going to stay there for a variety of reasons, that can be fine. And then those that are national, there's going to be kind of a constant, I believe, push towards the national model because of the internet. Right. I mean, this is just if you can find new members, if you can find new members through a credit channel, and then somebody signs up for a deposit account, you're going to want to do that if you can. And so I think it's going to become a long-term sort of trend that you're going to see of more and more of credit unions that are sophisticated enough to handle it are going to want to be able to have as wide a footprint as they possibly can.
Yeah, that leads me to think about another topic I've been debating with a few people. I don't know if we'll have enough time in this episode to get into, but the idea of a primary financial institution, does that exist anymore? What, the role of these institutions, whether they're banks or credit unions or community banks, do they serve a customer, or is there specialization in other products? And, no one really owns a customer, but you're kind of fighting for that next product.
Yeah. Well, if I think from a regulatory standpoint, you want the credit union to be able to offer the types of products and experiences that can keep it healthy over the long haul. And if it can't do that, then it's gonna wither, and you're gonna see, the consolidation and all the challenges around that. So I think that there is interest in a lot of this innovation from that standpoint. It's just that there's also that healthy skepticism of, is this innovation serving the credit union and the consumer, right? And so if you can show that it does both, and I think we have a lot of great data and studies to show that Upstart is one of those companies that does both. But I think you need to be able to be prepared to show that. Moving back, I think we're at an interesting moment in Washington, not only because of the election, right? We're at a moment where we're going to have a new administration either way, which doesn't happen very often, right? We're not, Joe Biden is not going to be president in January, so like that's a new administration. That's a big deal. So we're going to have a new administration either way to spend time with talking about financial technology, about AI and underwriting, about partnerships between supervised institutions and institutions that are regulated but aren't directly supervised in the same way. And we're doing that against the backdrop where, as we mentioned, there are all of these compelling reasons why, especially for any institution, but the very biggest of the largest institutions in the country that build a lot of amazing products in-house, for all but that handful of companies, partnerships are going to be the way of various kinds of the way that a lot of things move forward. And yet you have there have been negative headlines, not in the lending area so much, but on things like Synapse bankruptcy and others. Right now, there's a request for information from the federal regulators about third-party risk management at partnerships. We at Upstart will be responding to that. The American Fintech Council will be responding to that. And so, we're also making the point, all of these forums, whether it's the NCUA Examiners Forum or when we meet with the OCC or the FDIC or attend these conferences, we're spending a lot of time talking about the value. And then we also have to bring the examples where the rubber meets the road of where we think a regulation or implementation of regulation or supervisory question or expectation may be so onerous that it is going to disrupt a partnership, right? And so that's not where anybody wants to be. Nobody wants to be complaining, but you have to be willing to advocate on behalf of partnerships that have the chance to really move the whole financial system forward in a productive way, both for the institutions, for the consumer.
Yeah, totally agree. And I wonder, Nat, how did you leave Phoenix in that meeting with the examiners? Do you feel like they were bullish on the idea of partnerships and companies being able to help credit unions in that sustainability, like you mentioned?
I think they were bullish. I think that they, though, want to think about how to tease out whether an institution like Upstart with a lot of resources is the partner and able to, thousands of employees, able to support a partnership in a viable long-term way versus a vendor that might come with a lot of promises and not the ability to really deliver, right? And so I think they are going to be continuing to bring scrutiny, but I think it's going to be with more knowledge of Upstart, more and more understanding of how the partnership works and more understanding of the whole reason why. I think I mentioned just in the context of open banking, like why did you take their call? Like, why are you spending time? Why are you thinking about it? And understanding the many problems that we're solving for a smaller institution, from finding the member, helping do it with the underwriting, helping with the pricing, helping with the servicing, supporting fair lending testing, all of that rigor, and ultimately, keeping the viability and health of the institutions, that side of the balance sheet, not the deposits so much, but the credit side of the balance sheet, that is in a good posture. So that I think was the time well spent, let alone a lot of the time spent on third party risk management and kind of more of the in the weeds regulatory conversation.
Yeah, totally. Well, Nat, it's always great catching up. I'm always impressed. You have to know so much about so many different things and how Upstart operates in this space and the regulations that impact it. I wonder, is there a source of information you can share with us, that helps you keep up to date, whether it's, the points of view of some of these agencies, the news, the feelings of politicians, again, so many variables could go into impacting how these things turn out. How do you, is there a source that
I think it's
interesting?
I think it's interesting. I get that question a lot when I speak. Where do you get your news? How do you how do you keep on top of all of it? I think a lot of it is accumulated, and I think LinkedIn is a great example. When you've developed a career's worth of relationships, and then you're able to follow your network and curate your network based on what your, you know, interests are for Upstart, and then you're able to track a lot of what's keeping your network either up at night or what they're spending their time on. That can be an incredible source of news. So rather than what some editor, it's almost like the ultimate crowdsourcing of information, right? Rather than what some editor at the New York Times or the Wall Street Journal or the Financial Times or FinTech Daily decided they thought was important. You know, you read all those, but then you also have, you know, what those who are in the supervised community, like, you know, your potential partners, like what they're posting about AI. You have the advocates, what they're posting, the, you know, the civil rights community, and you're able to kind of track in a real time what is bubbling and try to see a little bit around the corner of what's coming, in a way that wasn't probably possible before that platform. So I do think that that's an incredibly powerful one for the type of tracking that you're talking about.
Yeah, that's a good point. Yeah, LinkedIn, with all its warts and like self-appointed gurus, like you filter through that to your network of people and see what they care about and where they're finding information. That's true. It could be a
Yeah,
good
you can't.
source.
You just. I mean, I just block the gurus. Like it's like people that I know that are, you know, they were just at Treasury or they were just at one of these regulatory bodies, and then they're posting something about something they were wrestling with. Like that's where the magic is. The people that are who are really employed in the workforce in the field that you're in, and really understanding what they're tracking, I think is powerful. So thanks for the conversation, Matt. It's great, and I think we'll be back at it maybe later this fall with a new set. But it's fun to talk a little bit about the NCUA and the event in Phoenix.
Definitely. Thanks again for joining, Nat.